What's up everyone, it's Kari with Money Vesting. In this video we are going to be talking about Walt Disney, ticker symbol DIS, and the stock here selling off a little bit over 8% on the day, dropping down to as low as $92. So we're going to break down exactly the numbers Disney reported, both on a revenue earnings basis, different segments, average revenue per subscriber, their subscriber numbers. All of that is going to be discussed. And of course, we're going to go over the technical analysis in this video as well. So make sure that you drop a like and subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. If you're interested in joining, there is a 16% annual discount till the end of this month. So if you want to take advantage of that, link's going to be down below for that as well. So let's just dive right into it. This right here is going to be Disney's price chart coming down to $92.31, and it has been on a significant decline since since the beginning of 2021. From all-time highs of well over $205, the stock is still down over 55%. Now, Disney obviously has gone through several changes on a more management basis, corporate basis, but that being said, it is still one of the strongest companies when it comes to content and the brand that it carries. So going over to the numbers, so Disney streaming losses improve even as subscriber numbers decline. So this right here, I think was the main reason why Disney stock fell, was the subscriber numbers dropping quarter over quarter. So EPS coming in at 93 cents per share versus 93 cents expected. So they had inline expectations. I think small miss because the expectations were 93.3 cents. So if you come over to this number, it was the estimate was 93.3. And the reported number was 93. So very, very, very small miss, more or less in line. And revenue came in at 21.8 billion versus 21.7 billion. But this right here, the Disney Plus total subscribers, big miss. 157.8 million coming in versus 163 million expected from the street. So I think that was the main key reason for this move lower. Revenue was up 13% on a year-over-year basis, $21.8 billion, and income from operations was up 93% to $2.1 billion, and on a 6-month basis, it's up over 40% to almost $3.9 billion, and revenue is up 10% on a 6-month basis for first and second quarter 23. Operating income was more or less flat, only down about 11%, and net income from continuing operations of 1.2 billion, up 100%, more than 100% year over year. And diluted earnings per share was also up over 100%, and diluted earnings per share excluding certain items, 93 cents, which was slightly down 14%. And free cash flow also up to almost $2 billion. And on a 6-month basis, they're almost positive with the free cash flow. And cash provided by operating activities at $3.2 billion, up 83% on a year-over-year basis. So I would say that all in all, these numbers were strong. I mean, we're seeing revenue growth, we're seeing operating income growth, we're seeing net income growth, we're seeing free cash flow growth, and we're seeing cash from operating activities also increase. Now, as I've already talked about Disney, like it has been on a consistent increase in terms of revenue. So you'll notice that from 45 billion to over 87 billion dollars, very nice growth. And gross profit has also gone from 20 billion to over 28 billion. But of course, operating profitability and net income profitability has struggled. During COVID, we did see a big decline because of their theme park and experience business taking a huge hit, which is now recovering. So you'll notice that their Disney Parks and Experiences products up 19% on a 6-month basis and 17% on a year-over-year basis for this quarter. And their media and entertainment distribution service, content media, is only up 3% year-over-year. So it's not growing at the same rate as it was before, but it's being offset by the Disney Parks and Experiences business segment, which is up double digits, up a lot more because of the reopening, because of more demand coming in for, of course, these Disney parks and theme parks. This right here is going to be operating income. So Disney Media Entertainment Distribution still very nice, profitable, 1.1 billion, but down 42% from last year. And Disney Parks experiencing now over 2.1 billion, and you can see that growth here, 23% for that particular business segment. This right here is going to be that Disney Media and Entertainment Distribution broken down into linear, DTC, and content sales and licensing. Most of them grew except for linear networks, which were down 7% on a year-over-year basis, and elimination of estrangement revenue. So this is again a very, very small amount. We can ignore it for the most part. But DTC, direct to consumer, up 12%, 5.5 billion. Content sales and licensing up over 18%, and they're both also up on a 6-month basis. So they're still growing in that particular segment, the linear networks are the only ones that they are pulling back on a little bit. Now, this right here are the numbers, right? Numbers in terms of their growth for subscribers. So Disney Plus, when it comes to domestic US and Canada, 46.3, that's down from 46.6, so 1% decline there. International, excluding Disney Plus Hotstar, was at 58.6, so small increase there, 2%. And Disney Plus Core, which is just a total of these two numbers, so Disney Plus, we're looking at 104.9, so just a 1% increase only on the back of international. But the key difference here is that the US and Canada market, it's obviously going to be much higher ARPUs compared to international. For example, I over here in India have access to Hotstar at much cheaper rates compared to maybe you watching in the US who has access to Disney Hotstar or Disney Plus, right? So pricing is different, and for anybody who is in the US or Canada, obviously is paying much higher for Netflix, for Disney, versus over here in India, which is where the prices are cheaper, because obviously it's catered towards a target audience where the purchasing power isn't as high as the consumers or the viewers over in the US and Canada. So Disney total plus 157.8 once you account for the Disney Hotstar as well, because we did see a bit of a decline there, 52.9 million versus 57.5, so that's an 8% decline, and as a result, total Disney Plus subscribers coming down from 161 down to 157.8. So the expectations were from estimates. Let's just go back a little bit. The expectations were 163.17. So Wall Street was expecting a bit of a growth, but instead they reported not only not growth, but also a loss of subscribers when it comes to Disney Plus. So this right here, this number is the main reason they're selling off. And you know what's even interesting is that Wall Street's focus very much seems to be on, I guess, on the number of subscribers, because this has happened with Meta. This has happened with PayPal more recently because they did decline in the active accounts. This has happened with Netflix, and this is now happening with Disney. It's a very common theme. But at the end of the day, I mean, don't you think that logically it makes sense to look at the revenue, look at the revenue numbers more? Because at the end of the day, it's the money that actually matters, not the actual subscribers. If companies are having more engagement on their platform or are able to generate more revenue by fewer subscribers, isn't that like a good thing? But yet Wall Street, for some reason, sees that almost always as a negative. When Meta started declining, they had their first quarter-over-quarter small decline in their traffic. Everybody went crazy, and it was like, hey, this is the beginning of the end for this company. Same thing happened with Netflix, and now same thing is happening with PayPal, even though PayPal's revenue and earnings grew, and they are guiding for more growth, but it sold off. Why? Because their active accounts were down 2 million quarter-over-quarter. And same thing with Disney. I feel like even though their Disney Plus accounts are down, I mean, there's a lot of cyclicality baked in as well. You have to understand these are very seasonal trends. I mean, people after the fourth quarter, going into first quarter, they don't like to spend as much. They're looking at their budgets. But as we progress through the year, people are just in general in more spending moods as we're getting closer to the holiday season. So there's a lot of variables at play, and obviously the business is going to go through these ebbs and flows. But at the end of the day, in my opinion, what really matters is the revenue number, what the company is actually reporting in terms of the money they're bringing in, as opposed to the subscribers. But Hulu numbers here, 48.2, so very, very small growth there. And you'll notice the reason why the revenue was up is because the average monthly revenue per paid subscriber was up. So $7.14, that's a 20% increase for the average subscriber that's actually paying that revenue. And international was up to $5.93, that's a 6% increase. And Disney Plus Core total was up 12%. So even though fewer subscribers, they were able to make more money because more money was being paid per subscriber. Disney Plus Hotstar was a small decline there, and global Disney Plus was up 13% in that per paid revenue subscriber, 444. ESPN was up 2%, and then we got Hulu. Live TV was up 5%, and the other SVOD was down a little bit over 6%. So there's our answer, right? They're able to make more money with fewer subscribers because per subscriber they're generating more revenue. At the end of the day, I think the revenue, the cash flow, and the earnings is what really matters, or should really matter on Wall Street, but apparently it doesn't. So this right here is going to be the technical analysis. My fair value is going to still be at $80. Now, on a more separate note, I think the one thing that does concern me about Disney is the debt levels that it carries, right? So I've mentioned this before, that the company obviously has over $48 billion worth of debt, $10 billion worth of cash, so net debt is at $38 billion. I would want to see this company pay down their debt over time, because you'll notice that on an annual basis, the net debt has only increased. It's gone from 16 billion to 41 billion in 2019, and then it has since 44 billion in 2020, it has slowly and steadily been coming down $2 billion a year. On a quarter-over-quarter basis, you can see that we are a very, very modest decline in the amount of debt, but I really want to see more payoff, more debt being paid off over time, so that I can be a little more confident about the long-term future for Disney. But that being said, support level is going to stay put at $84. So this right here is going to be that level to watch. My fair value stays put at $80. Does seem a little bit of an overreaction simply based on the subscriber count, but that's just how the markets are. I mean, we've seen this play out for so many companies, right? For Meta, for Netflix, for PayPal, and now for Disney. So I hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. $80, $79 to $80 is what I'm watching. That's going to be the pandemic low, and that's going to be in line with this green rectangle. But the debt level is what concerns me a little bit. But overall, I think the numbers were good. When you look at the revenue numbers, of course, subscribers numbers not so much. The best thing would be, subscribers and average revenue per paid subscriber growing. Both of those metrics growing, but we don't live in a perfect world, right? So we can't have everything, right? So that's the way things goes. Hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Drop a like, and also the link to our Discord Patreon is going to be down below. 16% annual discount. As always, happy investing. I'll see you all in the next video.